On, everybody. First of all, thank you so much for joining New Money Millionaires and for tuning in to Stock Market 101 Part 1. I'm excited to dive into this for anybody who's new into the stock market, whether you're advanced, you're a beginner. Hopefully this is a great refresher and a great informative presentation to get you up to speed and to just really expand upon your knowledge as to what the stock market is and how you can capitalize on it on the multiple different facets. So we'll be covering a couple different things, and let's dive in right now. So first things first, guys, getting started, we're going to be going over understanding the stock market. We're going to also be going over public versus private companies. We're going to be going over the difference between investors versus traders. We're also going to go over how stocks move, how you make money, and when to buy and sell stocks. And then number 5, the last thing we'll cover is how understanding indicators and how you can use that to almost be like a crystal ball in foreseeing how a stock is going to move, how the price action is going to change, and how you can benefit from it. So let's dive in. So how does the stock market work? The stock market is a web-based marketplace where investors come together to buy or sell portions of different companies amongst each other. The act of buying and selling is called trading, and the portions of those companies are called shares or stocks. Companies use the stock market to collect money from investors like you and I to help them in growing the overall value of their business. Now, what is a stock exactly? So companies need money, as we said, to help them grow. Now, what do they use that money for? They use it for all kinds of things, like buying materials to make their products, developing new products, building plants, hiring people. From a vast majority of different uses, they can get this extra income that's not coming from institutions or government assistance. This can come from retail investors like you and I to help them grow their company. And in order to raise that money, they often split the ownership of the company into smaller shares that they then sell to the public. These shares are also called stocks. So that is essentially the definition of a stock. Is just a piece of a company, and a company that actually wanted to raise money for their business. They offered that as an availability to the masses. Now, moving on. How are stocks priced? The price and amount of those shares of stocks available to the public are decided on by the company as it IPOs. And we'll go over IPOing in a second here. For example, if a company needs $1 million for a new project or a new product, they can choose to sell their shares at $10 each, which would mean they have 100,000 available shares to sell to the public. They can also choose to make each share more expensive and sell them for $100 each, which means they will only have 10,000 shares available. So there can be a limited supply based upon the pricing of the stock on how much they've raised inside the company's funds, how much money the company's worth. They can price those shares accordingly. Moving on, are all companies on the stock market? This is a good question that many people don't really think about. Not all companies are available to be invested in publicly. So for example, privately traded companies only allocate shares to their employees or executives. Examples of this are like Stripe, Chime, Discord, SpaceX. And just so you guys know what IPO is, it's initial public offering. So this is when a company goes from a private to a public company. And now when a company is now public, they can allocate those shares to not only their employees and the executives, but to the public as well. This goes for the Magnificent Seven, Visa, Home Depot, Costco, Exxon, just to name a few. But just as a tidbit and a suggestion, it is strongly advised not to invest into a newly IPO company for at least 6 months for it to come out to its median price, for it to even out, to go through its ups and downs and come to a price where the market deems it to be reasonably priced at. So the exception being that you enter at a discounted rate. If you're able to get in pre-IPO to a company and you're planning to hold for a long period of time, then that situation is justifiable. Now, here are the biggest publicly traded companies, the Magnificent Seven. We have Amazon, Apple, Meta, Microsoft, Nvidia, Google, and Tesla. This is as of April 2nd, 2024. And the craziest part is some of these companies weren't even in here less than 5 years ago. Nvidia and Amazon have rose through the ranks and claimed the throne of many, including Tesla as well. A lot of these other companies have been here for a long period of time, but some are new, and that's the beauty of the market. Some companies, it's an eat or be eaten game, and the top 7 can often change, which is crazy to say. Now, how does it all work? So a stock exchange is an institution which hosts a market where traders can buy and sell stocks. Now, traders can make money by buying the stock before the price goes up and then sell it before the price goes down. Now, the price of the stock reflects the available information about the financial health of the company. So, however the company is doing, whether you go and utilize Yahoo Finance and you go and look at the specs of a company, if it's a profitable company, the stock typically reflects that price, and also it reflects what's going on to the news outlets. What type of partnerships are they getting? Are they getting funding? Are they doing well as a company? Are they making a big difference inside the world? These things severely impact the stock's price. Now, traders watch a stock rise and fall, and you have to make the decision based on that of when to get in and get out. And we're going to get into how to determine that as well. So, how do you make money in the market? There's investing versus trading. There are two main types of people that are buying and selling in the market. There are traders and there's investors. Short-term mindset versus long-term mindset. Now, the difference between a trader and an investor is the trader will buy a stock when the price drops and sell it when the price goes up for a short-term profit. Investors buy a stock with no intention to sell it over the short term, but to hold for a long period of time, example, 20 years, adding more shares as time goes on, which is a long-term mindset. And as you guys can tell from the picture on the left of the different time frames of how they look at things, and I want to highlight a couple different things here. So on the investing in value versus investing in price, when you invest in the value of a company, you're investing in what the company can do or what it is doing or what it's done in the past. When you're a trader and you're investing in the price, you simply care about where the price is based upon the metrics of the company and how well they've been doing versus how bad they've been doing, and you decide to enter based upon that rationale. Same with fundamental analysis versus technical analysis. Fundamental analysis is when you're looking at a company's health. Have they been profitable over the last few quarters or the few years? How are they doing with their partnerships? How's the stock performed over the last 5 to 10 years? Is this a good time to buy versus a bad time? Trading looks at technical analysis. What are the indicators showing you? What are the percentages? How much has the stock risen and fallen in a specific amount of time? That's what technical analysis is. And then, of course, investing versus trading, risk management. You'd never buy a stock at the high. You want to always buy low and sell high. It's one of the biggest rule of thumbs when it comes to investing. And then the trading is focused on volatility. If a company's dropped dramatically or risen dramatically, you want to capitalize when it reverses in the opposite direction, because nothing stays up forever, just as nothing stays down forever in the stock market. Now, what buying style works for you? What type of buyer do you want to be? Are you looking to set it and forget it, or have more hands-on approach with a higher risk versus reward? These are the questions you got to ask yourself. Now, remember, investing long-term alleviates you the need to look at your investments daily or even weekly. Shoot, maybe even quarterly. At the most, you could do quarterly and do a reconstruction based upon your profits, based upon how companies are doing, based upon the news that you've had or heard from a company. That's the only time you really have to take a lot of time or energy or research to go and look at your investments for the long term. Now, being a trader requires you to be present with your positions and enter at least daily, look at it at least daily, weekly, and sometimes even multiple times a day, depending on your expiration for your positions. If you're a day trader as opposed to a swing trader, these are things you got to take into consideration depending on what you want to do. Now, you can also be in both. You can also be both. You can utilize your profits from trading to exponentially grow your long-term investing, which is something I personally do as well. Half of my profits I make from trading, I put right into my long-term investments to make sure that they're growing and getting me faster to retirement, faster to not having to be working at a job for the rest of my life. Let's move on. So how do stocks move? They move in a flow. This was introduced and updated by Mr. Gerald Peters. If you guys don't know who he is, look up Mr. Full Auto on YouTube. He came up with this strategy and revised it from another previous investor back in the day called the money flow. So every stock, whether it's on the daily time frame, on a monthly time frame, if you look at the history of a stock, you're going to notice that this is how the stock has moved at some point inside of his journey or multiple times inside of his journey. Stage one is the accumulation, where retail investors, people who really like a stock, they'll just accumulate and buy the asset. Now, what makes it go to stage two at the breakout? That's institutions. That's government money. That's big money coming in and starting to buy a stock and increasing the price and marking it up. And that's when you want to get in ideally. That's when you can capitalize on a stock's momentum to the upside. Now, stage three is when the stock has rose to an amount, but not a lot of money is adding to that pot, if you will. Now, typically, it does go down to stage four, which is when you would want to exit and secure your profits. But sometimes it goes from stage two to stage 3 to stage 2 again if there's a lot of momentum inside the company. If a lot of investors, a lot of institutions see value in a company, they will add more money even at stage 3. So it's really important that you be mindful of where a stock is inside of its journey, especially if you're trading. If you're investing, then long term this may not apply to you as much. However, you do want to do your best to start accumulating at stage 1 if you really like a company, and even better at stage 2. And you want to definitely get out of the position at stage 4 if you're not playing to hold for the long term. Now, how do you make money in the stock market? Like we just mentioned a second ago, you buy low and you sell high. So on the left here, we have Meta, guys. This is a really amazing example of having and understanding a chart and getting in at the right time. So this was a reference to 2022, right after COVID happened and the pandemic happened. Meta stock dropped significantly down all the way from almost $400 down to $90. A lot of people thought the company was done. They thought there was no hope. And this is on the monthly time frame, by the way. They thought it was no hope. And just as fast as it fell, it rose with roaring authority and resilience and brought its share price almost 4x whatever you paid for it. So if you look at the example here, if you bought it at the low at around $90 and you held it to the top where it is right now, April 2nd at 2024 at $485, you would have made $395 per share that you own. So if you had 10 shares, you would have made over $3,000, almost $4,000, more than $4,000. If you had put in $9,000 into, or you bought 10 shares, or 100 shares of Meta, I should say, you would have well over $40,000 from believing in a company rebounding based on the technical analysis that you see here. And we'll break this down further, guys. So if you sold the stock on the day the price was higher than you originally paid for it, you would make money. But if you sold the stock on the day when the price fell below the price you paid for it, you would lose money. So if you were someone who bought Meta before it fell down and at the high at $400 before the pandemic happened, and you sold it at $90, you would have lost whatever you placed inside that trade. So if you bought it for $400 and you sold it for $90, you would have lost $300 something instead of gaining $300 something. So it's important for you to be very mindful of when you get in and when you exit certain positions inside the stock market. Now, when do you buy or when do you sell? We have 5 primary indicators on the chart that give you a clear indication, or at least a premonition, if you will, of when to buy and when to sell. These 5 indicators are the 5-day exponential moving average, the 20-day exponential or 20-day moving average or 20-day MA, the 200-day moving average, the 200 MA, and then the RSI, which it measures the speed and change of the price's movement. And any type of time the RSI is above 70, it means the stock has been overbought. Too many people bought it too quickly. The RSI being under 30 means too many people sold it, and it's way too good of a bargain for it not to rise back up. The moving average convergence divergence, or the MACD, used to show the strength and momentum and direction of what a stock is doing. So all of these are just early warning signs and signals that tell you about how a price is about to move up or down. Now let's see that inside a visual sense, okay? The RSI here, let's use Meta example again. So we're going to zoom out here and show you guys the full range of this picture. So right now, currently April 2nd, 2024, Meta is extremely overbought. That means the RSI is above 70. As you can see, it's above that. It's about 78 right now, which means it's very overbought, and it's more than likely due for a pullback to the downward direction as a healthy correction for the stock to not be overinflated. And if you go and look over here down below, over at the green line that's crossing over the orange line that's circled, the second circle to the top, when the 5-day EMA crosses the 20 EMA, or the 20-day moving average and the 5-day moving average, that is your signal to buy. So if that happened there, it would show you that there's strong enough momentum inside this company for you to go and buy the stock at this level that we're at right now. That bottom part would have been great if you caught it at the $90 below, but the true price to buy, where it would have given justification on the indicators, was when it crossed from that green into the orange. And if you look at the bottom part, guys, the MACD is also hot. That means the stock has a ridiculous amount of momentum and strength, almost too much, and it's more than likely going to be due for a pullback as well. Now, if you go to this next position here, I want to give you guys another example. We have MMM. This is a company that dives in with helping with parts from automakers. It helps with supplies in stores. It supports many different companies in being able to provide. You'll see a lot of their products in Home Depot and Lowe's. They are a great company that supports with that. Now, this is the opposite of Meta right now. MMM actually now has crossed, if let's go from the top here, the RSI is actually low. If you see the RSI at 30 or below 40, typically that means the RSI is low and the company has been oversold and is due for a rise afterwards, okay? Now, if you look at the 5-day EMA, it crossed over the 20 right here today, April 2nd, 2024. This is my signal to get either a long-term expiration option position or to start my shares inside this company. This is a great time to buy this company for the long term if I wanted to own it. Let's move down as well too. The MACD is very low, but you see it is now crossing over itself into the upside. That is a signal to buy as well. Both of these signals, the RSI and MACD, are great signals for you to buy a investment as well, or to sell out of an investment as well. Well, guys, that was everything I have for you inside part 1. Stay tuned for part 2. I hope this was very helpful. If you have any questions and concerns, please reach out to any of the admins, including myself, Preston Nabu. Thank you so much again for being part of New Money Millionaires. Let's get this bread.